Good evening, class, Mercy. And there's a person with Infinix. Good evening, class. Are we there, team? If you're there, we just respond with a yes. We were on latest, double entries and latest. We were on latest. Asante, Betty. Where is Elizabeth today? Is Elizabeth there today? Is Elizabeth there today? Elizabeth, are you the one with Infinix? Elizabeth, are you the one with Infinix? Betty, were you able to finish the question so that you help us balance cut it down? Those balances that are cut it down. Were you able to finish the question? Betty, were you able to finish the question? If you're able to finish the question, you just respond with a yes. Betty, respond very fast so that we just. Were you able to finish the question? Were you able to finish the question? Marcy, were you able to finish the question? Because the same question is what I wanted to do. I wanted to do the trial balance. Trial balance. Were we able to finish the question? It was the same. Were you able to finish the question, man? Can you send that question to the group? The one who took a photo of that question. Elizabeth, are you there? Did you take a photo? Elizabeth, if you're in Phoenix, then just send that question so that we do the trial balance for that question. We are able to finish the question. If you're there, you just respond and send the question to us. Were you able to send the question? Send that question to the group. Are you Betty in Phoenix? The guy, the gentleman with Infinix, is that Betty? If that is not Betty, then we can pick on very fast on. We can pick very fast on. We can pick very fast on. Just repeat that question very fast. Just repeat that question very fast. So we say this. The question is already in the group because some of us are not there. The question is already in the group. So being told the following transaction in the ledger accounts, so together we say that the following transactions are transactions in the books of Grace Limited altogether. So being told that on the 1st of March 2023, we started a business with 1.5. We started a business with cash of 1.5. So we opened the capital, that was capital account, and it was cash account. Very fast because we've done this question. So when you start a business altogether, we are going to debit the cash account and credit the capital account. There's increase in capital and there's increase in cash account altogether. There is increase in cash and there's increase in capital account. Are we together? If you're together, we just respond with a yes. Marcy, were you able to do the question? Somebody called Ellen. Ellen is no longer. Marcy, were you there? Were you able to finish the question? Ellen, were you able to finish the question? We respond.
No.
You did the question?
No, I wasn't able.
You are not there. You are new in class. So we can proceed just to the question again. So the question is already in the group. Look at the question was sent already in the group. This is on ledgers. Tunaona hiyo swali in the group. Let me just forward it again. And then once we forward it, the question is already there. Just look at
Yeah.
You have it? Do you have the question? Look at if you're in the group, look at that question. It's already in the group. Are you able to see the question? Respond to the yes. Betty, Marcy, and Ellen.
Yes, yes, yes.
Yes, it's already
Yes.
there. So I can do that question as a quick wrap because Ellen was out there. So just a standard business with cash 1.5, with cash 1.5. So the two accounts that are affected is the cash account and the capital account. So capital account is increasing with 1.5 and cash account is also increasing with 1.5. So first we credit capital, that is 1/3 of 23. We have cash, we credit, that is 1.5. Then we have 1/3/23. We call it capital, very fast capital, 1.5. So that is the first entry. So the second one, we're being told that bought goods on credit from A Agnes. So bought goods from A Agnes, bought goods on credit from A Agnes. Two accounts that are affected there is purchase account, and we have liability account, which is called A Agnes. So I will create a purchase account, what's called purchase account. I have purchase account, and I have another account called A Agnes. So when you buy goods on credit, what happens is that there's increase in purchase and there's increase in liability. There is increase in purchase, and at the same time, there's increase in liability. So purchase goods on credit. So purchase is going to increase because that's increase in expense. That was on second. That is of 23. Agnes, 296. That's 296K. Then Agnes, we know that is liability. So we credit the liability. That is on second of 3. That is, we call it purchases. 296. Purchases 296. Tuko sawa mpaka hapo? Are we together up to that very point? We respond. And I want us to try and sort this question very fast. Together? Together, team. So the next that is on third, paid rent by cash. So paid rent by cash. So if you pay rent by cash, the two accounts that are affected is the cash account and the rent account. Cash account is already there. So we open a rent account. We open a rent account because cash is already there. So when you pay rent by cash, we are reducing cash and we're increasing expenses rent. So we're going to debit expenses account with cash of 28, and we're going to credit cash account with rent of 28,000. Together, team. Are we together, team? I want us to respond. Tuko pamoja. Are we together?
Yes.
Are we together? Kindly, could you respond?
Yes, yes. Yes, yes.
Asante, if you're together. So because those were not there, so we are going to debit that is on third of 3 of 23, that is cash. That was 28,000. Then the cash account will credit with rent. That is 3 and 3, we call it rent, 28,000. 28,000. Then I proceed to the next. I'm being told that bought stationery, shillings 15 paying by check. Bought stationery. Before that, there's 4 paid 1 shillings 1,000 of the farm into the bank. So paid shillings 1,000 of the farm into the bank. So that is deposit. So when you deposit money into the bank, we affect the cash account and we affect the bank account altogether. The money is being taken from cash, so cash is reducing It means that we're crediting the bank, we're crediting the cash with bank of 1,000, and we're debiting the bank with cash of 1,000. The cash is already there, so we open the bank on this end. We open the bank. So we say for bank is increasing of 3, we call it cash. That was put there, that is 1,000. Then on the cash side, that is the 4 of 3, we call it bank. That is 1,000. Here you go, sawa. Is that okay? If that is okay, you just respond with a yes. Asante, if that is okay. I assume that silence means that we're okay. Then you say that bought goods on credit, bought goods on credit, bought goods on credit from Sarah, sold goods on credit to Sarah, shillings 54,000. That 54 is shillings 54,000. Bought goods from Sarah on credit, shillings 54,000. So if you buy goods on, when you sell credits on credit, when you sell goods on credit, we create one of the accounts that we create the sales account. We call it the sales account. And the person who buys goods on credit, we call that account debt account. So Sarah, we know that Sarah is a debt, a debtor. A debtor is an asset altogether. So there's an increase in asset called debtor, and there's increase in sales, which is income. So increase in income, which is sales, we credit together. So that was on 5th. So we come here and say 5th of 3. We call it Sarah, who is a debtor. That is 54,000. That is 54,000. Then debtor is an asset, we debit with sales. Sarah is a debtor, so that is 5 of 3. We call it sales. That is 54,000. That is 54,000. Tuko pamoja. Are we together up to that very point? Are we together? If you're together, we
Yes,
just yes.
Yes,
Asante.
yes.
So then we move to the next. We're being told that bought stationery, shilling 15 by paying by check. So bought stationery, shillings 15, paying by check. So there's an expense account called stationery, and there's an account called bank altogether. So the money was taken from the bank, which is an asset, is reducing, but expenses called stationery is increasing. So the bank account is already open, so we can open another account called stationery down here, we call it stationery. So for the stationery is an expense account. So we are debiting stationery account, so that is 7 of 3, we call it bank, we call it 15. Then we go to the bank, it's reducing, we say 7 of 3, we call it stationery, that is 15. Together, team, that is 15 for the stationery. If that is okay, we respond with a yes. So I proceed to the next. We are being told that made a cash sales of shillings 49,000. Made a cash sales of shillings 49,000. When we make sales, there's increase in sales, but also there's increase in cash because we are receiving cash. So there's increase in sale and there's increase in cash. Those accounts are already opened. So on the cash account, we are going to debit with sales, where we're saying that sales, we are going to say that is 11 of 3. We say sales, that was 49,000. On the sales account with credit, that is 11 of 3. We credit with cash, that is 49,000. Tuko pamoja, that is 49,000. Tuko pamoja hapo? If you're together, we just respond with a yes. So there's a question in the group. Are you in the group, Peter? Pat, are you in the group? Betty, forward the question. Forward the question.
Okay, okay.
Forward the question to the group. And please be consistent in class.
Okay.
A number of people are not very consistent with class. In fact, we're repeating the question because of you people. Yes. Once you forward, you let me know, kindly.
Okay.
So when that happens, when you make cash sales, cash is going to increase and sales is going to increase. So we credit sales with cash and we debit cash with sales of 49. We debit cash with sales of 49. Kama tuko sawa tubonyeze yes. Kama tuko sawa tubonyeze yes. Have you sent the question? If the question has been sent, just say yes. Are you in the group, Pato? Pato, are you in the group? Sent, it's already sent. So then I proceed to the next. We are saying that that is on 14th. Return goods, goods returned by Grace to Grace Limited, 17,000. So goods returned, we say that goods returned by S Grace to Agnes altogether. To Agnes. Goods returned by S Grace to Agnes. So now goods were returned to Agnes. So what is happening? The business is returning goods to a supplier. So those are returned outward, outwards. I open an account, I call it return outwards. I call it return outwards. I call that account called return outwards altogether. Return outwards. So purchases return, purchases return. It's to call purchases return, return. We also call it purchases return. Purchases return. Tuko sawa? So when goods are returned by the business, what do? We debit the liability account because it's reducing liability. So we debit the liability account and we credit purchases return. So liability account, we are going to say on the liability account, we are going to say we're going to debit, that should be 14 of 3. We say return outwards, that is 17,000. On the return outwards, we are crediting A Agnes. So we're going to say 14th of 3, A Agnes, that is 17,000. A Agnes, that is 17,000. So when goods are returned, we create a return outwards account together. When goods are returned by the business, we create a return outwards account together. So the liability is going to reduce. So that's why we debit liability account with return outwards. Then return outwards we credit with A Agnes. Tuko sawa mpaka hapo? If you're there, we just respond with a yes. P. Pato, Ellen, Betty, are we there, all of us? Thanks, Betty. So then we say that goods sold on credit to Elliot. Goods sold on credit to Elliot. To Elliot. Goods paid on credit to Elliot. Goods sold to credit to Elliot, shillings 29,000. So good. Yes, that question, some of the students were not there. So that's why we've repeated. Some of them were not there. I was looking for these answers. Are we together? Pato. Are you Elizabeth? Pato, are you Elizabeth? Are you Elizabeth, Pato? So I wanted you to send for me that. Yeah, that is good. I wanted you to send for me the whole of those answers. That's what I wanted, but you're not in class. But for the sake of those who are not there, we can finish it. And then we go to we do the trial balance. Just allow me to finish it. Then we do the trial balance. Is that okay? just allow me to finish so that we do the trial balance for those who are not there. So when you sell goods on credit, when goods are sold on credit, that is on 17, to E. Elliott at 29. So E. Elliott is also a debtor. So we have Elliott, that we know is a debtor. That is also a debtor. So when you sell goods on credit, the accounts that are affected are debtors account and sales account. So for the sales account, we are going to say 17 of 3. We call it Elliott. That should be 29,000. Then Elliott is a debtor, which is an asset. We're going to say 17 of 3. We say sales, 17,000. Sales is 17,000. Sales is 17,000. Sales is 17,000. Then I proceed to the next, where we're saying the next where we're saying that the next where we're saying paid for repairs of the building. Paid for repairs by cash, 17,000. Paid for repairs of the building, cash, 17,000. Repairs are expense altogether. So we're going to, it's going to affect expense account, which is repairs. We can have that expense account called repairs here. Repairs. And cash is coming from the bank. So paid for repairs account. Repairs of the building, 17,000. So we debit, that should be 20 of 3, because cash, 17,000. Then on the cash account, we're reducing, say 20 of 3. We call it repairs. Repairs 17,000. So there's a repairs of 17,000. Repairs 17,000. Then we can have the next. We're saying that return goods we say that Sarah returned goods. We're saying that Sarah returned goods. Sarah returned goods to Grace Limited of 14,000. Sarah returned goods to Grace Limited, 14,000. So when Sarah returned goods, those are now returned in what? Return inwards. Return inwards. So those are same as sales return. Sales return. Those are same as sales return. So for the sales return, we are going to reduce the debtors account. So saying that the debtors account that is on 23rd. So we have 23rd of 3. We have sales return. Sales return. That is 14,000. Sales return, that is 14,000. Then you're going to debit sales return by Sarah. That is 23. 3 Sarah. 14,000. Tuko sawa on that. Tuko sawa na hiyo. If you're together, are we together? We just respond with a yes.
Yes.
Tuko pamoja? Asante Ellen. So then we proceed to the next. I hope you're almost done with this. Paid Agnes by check. Paid Agnes by check. Shillings 279. Paid Agnes by check. Shillings 279. So when you pay by check, bank is reducing. So saying that that is on 24th. So 24th of 3, we call it Agnes, 279,000. And then we come here, we debit because we get paid 24 of 3, we call it bank, 279,000. 279,000. But this account, if you look at this account can be balanced. Because when you add that to that, this account already, we don't need to even hold it. That should be 296,000, 296,000, 296,000, 296. So that account is already balanced. That account is already balanced. So I can proceed to the next, where you're being told that bought a motor vehicle. So we're being told that cash purchase 28, there's a cash purchase of 125,000. Cash purchase of 125,000. We have a cash purchase of 125,000. We have a cash purchase of 125,000. Cash purchase. So when you make a cash purchase of 125,000, what happens to that cash purchase of 125,000? Cash purchase of 125,000. Which accounts affected when we say cash purchase of 125,000? Cash purchase of 125,000, which two accounts are affected when you have a cash purchase of 125,000? When you have a cash purchase of 125,000, which account is affected? So purchase account is affected, there's increase in purchase. So cash purchase, that should be, we have 28. We have cash purchase. That is cash purchase. That is cash 125. Then we have on the cash, there's reduction. We have 28 of 3. We call it purchases 125. Purchases 125 together. Then we're being told that the second last, we're being told that paid motor expenses. Before motor expenses, we told bought motor vehicle 395,000 by check. 395 by check. So we can open motor vehicle account. Down here we call it motor vehicle. Motor vehicle, this is an asset account. Motor vehicle. And that motor vehicle account, we are saying that we are debiting. We say that's 29 of 3. Bank 395. Then bank will credit. We call it 29. Motor vehicle 395. Motor vehicle 395. Then we have paid motor expenses. That those are expenses, motor expenses. Paid motor expenses. That's an expense of an asset, motor expenses. Paid motor expenses, 15,000 in cash. So cash is reducing, expenses increasing. So we have budget of 3. We call it cash, 15,000. This we have budget of 3, that's motor. Motor expenses, that should be 15,000. That should be 15,000. Motor expenses, that should be 15,000. Then you have the last one, bought fixtures on credit from R. Robert. So bought fixtures are asset, R. Robert is a liability. So we can open up here very fast and say R. Robert, we know that this is liability. R. Robert is liability. So there's increase in liability. So we call it, that is 31st of 3. We call it fixtures. That is fixtures. That is 120. Then we open an asset account called fixtures. An asset account called fixtures. I can open it here, fixtures. So fixtures are debit because that's an asset. That is 31 of 3. We call it Robert 120. So nimemaliza entry zote. Are we in agreement that all entries have been made? Are we in agreement that all entries have been made? So this was not annual, but it was called P-loots. P-loots. This was called P-loots. P-loots. So to consult it, if you're together, we just say yes. I want us to balance this account. Kila mtu ako sawa? We balance those accounts. In accounting, we can't leave those accounts hanging, so we balance them. Can I proceed to balance this equation? Those ledgers. Nani ana swali? Kuna mtu ana swali? If there's a question, we just respond and say, Mwalimu, there's a question somewhere in here and here. So we balance them. So just say when you balance this will say that first at the end, we have balance carried down. That is 1.5. 1.5. That is 1.5. We have it there. This is balanced 1.5. 1.5. That is definitely balanced. We have that one rebalance carried down. That is 28,000. So this is balanced. 28,000. Then this we have this side. So we have the balancing figure is 54. 54. So we have that first of three balance carried down. That should be 40. That should be 40. Then I have this 31st at the end of three. Our balance carried down. That should be 17. So 17,000. 17,000. That should be 17,000. Then you can balance this returning once. So I have that 1, 3. Balance carried down. That should be 14. So 14 on that. That is balance. That is balance. So then I proceed to purchase a return. So I know that 31st of 3, balance carried down, that is 17. 17. It's okay.
Yeah.
Then motor vehicle. Motor vehicle. We can balance the motor vehicle. So we know that 31st of 3, balance carried down, that should be 395. 395. Then our Robert's liability, we have that first of 3 balance carried down. That is 120K. So balancing figure, that is 120. 120. Then we have payloads, which is the data. Payloads on the first. We have balance carried down, that should be 17,000. That is 17,000. So then we have sales account. We have sales account. So what is the balancing figure for the sales account? What is the total of the balancing figure? If you're to handle sales account, and the balancing figure should be 54. 54 plus 49 plus 29,000. So that should be 132. Are we having 132? Are we having 132? Betty, are we having 132?
No, I don't. That is for sale.
Yes. Do you have your calculators?
Using my phone, but allow me to. That is for sales.
Yes, for sales. What is the balancing figure? So 54, 49, 29. Elizabeth? ln tuko sawa?
I'm not
So
seeing
then
well.
this ln, are we together?
Yeah.
That is great if you're together. So then the balancing figure, at first we know that 3 balance carried down is 132. So 132. That was already balanced. We go to the bank. To the bank. The balancing figure should be the credit side. The balancing figure should be the credit side, 15 plus 279,000 plus 279,000 plus 395,000 plus 395,000. So the balancing figure is 674, 674, 015. So we have 674, 015. So that first of 3, we have balance carried down. So minus 1,000. So 674, 015. So we have 673, 673, 015. 673, 015. 673, 015, 015. So then we proceed to this, to purchases. Total purchases, that should be the balance figure for the purchase, 296,000 plus 125,000. So that is 421. I have 421, 421. So we know that 31st of 3, balance carried down is 421. Two more is 421. So we have only 2 accounts that are remaining. That is motor vehicle expenses. So we know that the balance figure is 15,000 for motor vehicle expenses, 15,000. So we know that 31st, 3 balance carried down is 15,000. Balance carried down is 15,000. Balance carried down is 15,000. Then we can balance the cash account. This side when you look at the cash account, which side is bigger? Is it the debit? Definitely the debit side. So debit side is the bigger side. So that is 1.5 plus 49,000. So we have in this place 1549,000, 1549,000. So we have 31st of 3 balance carried down. So what is the balance carried down at that point? I will have minus 28,000, minus 28,000, minus 1,000, minus 17,000, minus 17,000, minus 17, minus 17,000, minus 125,000, and minus 15,000. So balance carried down for the cash is 1,363,000. Tumemaliza hapa. Kila mtu amecopy that. I want us to go now to trial balance. Tumemaliza hiyo. We say that on the trial balance, before we get to the financial statements, on the trial balance, we take the balance carried down. This balance is carried down is what help us to get the trial balance. So copy that and you let me know once you're done. Trial balance. Trial balance. Tuko pamoja. If you're together, we just respond with a yes.
We are together.
Asante, I want us to pick on the trial balance. Say this on the trial balance. So just say that trial balance, I dictate those ones, then we do the trial balance. Trial balance is a schedule of all balances. So trial balance, I want to use this figure so I don't want to rub it. Trial balance is a schedule of all balances. Is a schedule of all balances. I dictate is a schedule of all balances. Trial balance is a schedule of all balances. In ledger accounts, is a schedule of all balances in the ledger accounts. After ledger accounts have been balanced. A schedule of all balances in the ledger accounts after ledger accounts have been balanced. After ledger accounts have been balanced. After ledger accounts have been balanced. After ledger accounts have been balanced together. So you say that it is based on the concept of double entry. It is based on the concept of double entry. It is based on the concept of double entry. And as such, it must balance. And as such, it must balance. And as such, it must balance. So we go to purposes of trial balance. Purposes of trial balance. The next is purposes of trial balance. Of trial balance. Purposes of trial balance. So number one, purpose of the trial balance. Purposes of the trial balance. Number one, we say this as a purpose used in preparation of final accounts. The first one is preparation. We say preparation of final accounts. Of final accounts. That is the first one. Number two, we say it checks on arithmetic accuracy. Checks on arithmetic accuracy. Checks on arithmetic accuracy of ledger accounts, whether they were done correct. Arithmetic accuracy. Arithmetic accuracy of ledger accounts. Of ledger accounts. Then lastly three, I've said number two, check on arithmetic accuracy of ledger accounts. Number one, preparation of final accounts. Number two, checks on arithmetic accuracy of ledger accounts. Then number three, we say checks for errors. Checks for errors. It checks for errors which might have occurred when posting transactions in ledger account. It checks on errors which might have occurred when posting transactions in ledger accounts. Check on errors which might have occurred when posting transactions in the ledger accounts. Checks for errors which might have occurred when posting transactions in the ledger account. When posting transactions in the ledger accounts. And lastly, before we do the trial balance, we talk about weaknesses of trial balance. Weaknesses of trial balance. Weaknesses of trial balance. Weaknesses of trial balance. So weaknesses of trial balance. Weaknesses of trial balance. Number one, say this. It does not provide useful information. It does not provide useful information. It does not provide useful information about the business. So number one, weakness of the trial balance. It does not provide useful information about the business. E.g., it can't show, i.e. it can't show financial performance. That even after getting the trial balance, this one cannot show the financial performance. it does not provide useful information about the business. E.g., it can't show the financial performance of the business. It can't show the financial performance of the business. The number two as the last one. Number two as the last one, we'll say that it does not provide absolute proof of accuracy. It does not provide absolute proof of accuracy. It does not show absolute proof of accuracy because certain, it does not provide or show absolute proof of accuracy, because certain errors may not be detected by the trial balance, because certain errors may not be detected by the trial balance, because certain errors may not be detected by the trial balance. Together, team. So that is not an absolute proof of accuracy. That by doing this, by taking this to the trial error and the balance is not accurate, is not absolute accuracy, because certain errors may not be detected by the trial balance. For example, e.g., error of omission, e.g. the error of omission. Allow me to take it as e.g. error of omission, e.g. errors of omission, e.g. error of omission. Together, team. So I want us to prepare a format for the trial balance. So make sure that this balance carried down, you put them somewhere. I'm rubbing this part. Are we together? We did not sort this picture, sorry. So we have that first of 3, balance carried down. For fixtures, that should be 120. And then you balance that is 120. 120. Apple. I want to rub a part. Ellen, Betty, and Mercy. Nataka kurab this part. I want you to copy this. So when I ask you for the balance carried down, utanipatia tukitengeneza trial balance. I want to rub this side together.
Yes.
Asante, if you remember. So I want to rub this part, and make sure you give me that. You give me that. So I want us to so I've rubbed that part. So I want us to have a format. For trial balance. Format for trial balance. Format for the trial balance. And now it goes about format for the trial balance. So format for the trial balance. So we have debit on this side, we have credit on this side. So balances of asset account, we debit together. Balances of expenses account, as this one we debit. Expenses we debit. Liabilities, we credit. Liabilities we credit. And you say that incomes, expenses we credit, capital account, we credit. So when this one is correct, if you did your entries correct, The balances for the debit side and the credit side should balance out together. The debit side and the credit side should balance. Tuko pamoja. The debit side and the credit side should basically balance. Tuko pamoja.
Yeah.
That is for the trial balance.
Number 2.
You say?
You number 2.
I can't hear you. Your voice is, you're breaking.
Number 2, later from assets, then you move.
This is expenses. I've said expenses
Okay.
with balances, assets with debit, liabilities with credit, incomes with credit, capital with credit. Tuko pamoja. Tuko pamoja.
Yes.
Asante.
Yes.
If we're together, so we can sort that trial balance. So we can sort that trial balance. So say that on that question, that was the book of grace, trial balance for S grace. So we can just say trial balance, and we see whether we did something nice on the latest. So say call it S grace, trial balance as at we say that 1st March 2023. So we have debit and we have credit. Tuanze na zenye zilikuwa hapa. So tulikuwa na fixtures. What is the balance carried down? We only take balances carried down. Fixtures zilikuwa ni ngapi? Fixtures zilikuwa ngapi? Balance carried down for the fixtures zilikuwa ni ngapi?
120.
120, that is an asset. So we debit, that is one. We also had capital. Capital is balance carried down for capital was how much? 1.5. Senior. With credit balance, we carry the balance carried down. So another one was on the other side, the ones that we tracked. To the corner repairs. Repair is an expense. Repairs is quite ngapi?
$17.
Repairs was 17. Yes, 17.
Yes.
Another one that was there. Another one that was there that we have not touched to the east side. Again, team munipatia.
We have
debt.
here.
Tulikuwa na debt za Sarah. Sarah, and you know Sarah is a debt. Debtor is an asset. Sarah ilikuwa ni ngapi balance carried down for this? Sarah was a debtor. Ilikuwa ni ngapi the balance carried down for Sarah was a debtor? What is the balance carried down?
14,000.
What was the balance carried down for the debtor who was Sarah?
14,000.
How much?
14,000.
Wait. No. Balance carried down. It's not the ones that were returned inwards. Tulichora hiyo. Angalia kama ulikopi. Ilikuwa ni 40, ilikuwa ni 40,000.
40,000.
40,000. Mercy, please check very carefully. That was 40,000. Another item in rubber that needed to be there. Ni gani? Nini ndio macho yangu tafadhali? An item that I wrapped that should have been here. Tumezimaliza zote. Have we sorted that, all of it?
Tutajua.
See, I wrapped this and I told you to just have it. Let me assume that it's on then we go to cash. Cash is an asset account. Cash is 1 3, that is okay. Please, nyinyi ndio macho yangu. So if you disappoint me, motor vehicle expenses. Don't say tutajua. That one you totally mess me up. That is 15,000. Motor vehicle, that's expense. Return outwards. Return outwards. Return outwards. So return outwards is a reduction of purchases, so we credit it. So return outwards, that is 17 with that. Then we have return inwards. Return inwards is a reduction of sales. So we debit that. That is 14. We debit that, that is 14. That is 15. Then I have purchases. Purchases is an expense. Purchases, that should be 421. 421. Then you look at the bank. We go to the bank. Bank nigga. Remember, if bank appear here, this is an overdraft. This is an overdraft in liability. Balance carried down your bank appear on the debit side, that's a liability in a manisha overdraft. So overdraft, in liability, overdraft, that should be 673,015. Na tu kumaliza ingine hapa. So that's that first macho yangu. Balance carried down, that should be 15. So this one we can sort 15. So we have stationery, which is an expense. A stationery, that is 15. Then you have an asset called motor vehicle. So you have motor vehicle. Motor vehicle asset is an asset, so that's 395. 395. Then I have data, which is called loads. Data, which is called loads. A data that is called loads. Loads. Loads, P loads. That's a data. A data is an asset. So P loads, that should be payloads, that should be. Sorry, payloads was 29. Sorry, here it's 29. You guys did not even remind me. Payloads was 29. 29, so that should be 29, 29, 29. So this is 29, 29. We have it there. So payloads is the data that is 29, 29. Then we have somebody called R. Robert. Robert is a liability. R. Robert. We know that that is liabs. Liabs we got for Roberts, that's 120. 120. Roberts is 120. Then we have this Agnes is sorted. E Agnes to Memaliza, it was balanced. Then I have the last one, that is sales. Sales is an income. Sales, that should be 132. Sales should be 132. Sales should be 132. So sales is 132. Is there any item that sijaongeza hapa tafadhali? Kuna item sijaongeza hapa? That good student who is following up on what I'm doing. Is there any item that I've not added on this for the trial balance? Kuna item to the wrap up and we have not included. Good people, good people. Remember, we are moving together, good people. Is there any item that we have not included or added? Is there any item that I've not included? Mercy, Betty, and
Rent.
Ellen.
Sioni rent. Rent.
I think we missed rent. Ilikuwa ni gapi balance carried down? I think we
28.
had how much?
28. 28.
28, that's an expense. So that's one. Another thing that we missed when we were having here, because you were supposed to check on that. Agnes was balanced. Hakuna balance carried down. Whatever we take to the trial balance, those are the balances carried down. That's what you take to the trial balance. Balances carried down is what you take to the trial balance. So we can assume that, so again balancing, if this one is correct, then this should be balanced. Those ones should be balanced. What is the total for the debit side? What is the total for the credit side? So do that for me. Do that for me. Do you have calcs? Mko na calc? What are you getting for the debit side? Hesabu zetu ziko sawa. Class, if they're not balancing, it means our ledgers zilikuwa mbovu. But if it's balancing, it means that our ledgers what? What is the total when you add this? Class. How much? I'm waiting for you. How much is that? How much is that?
Please confirm for me purchases, is it? Did we get for
Purchases are 421. This was 421, 296. You are taking long, you're taking long. I already have the answer, but I want you to confirm. I already have the answer, but I want you to confirm. How long does it take to confirm that? How long does it take to confirm? Do you have calcs? I am worried because you don't have calc. So this thing should be balancing 2,442,015. And when you add that, again, I can add just to confirm 1.5 on the credit side, plus 17,000, plus 673,015, plus 120, plus 132. The same, that is 2,442,015. So it means our ledgers were on point. Balance, imbalance. We may confirm imbalance. Here, imbalance. Imbalance. Is it balanced? Watu wangu tumeelewa? Is it understood? Is it understood? Is it understood? May confirm. So balance it. Is it balancing on your end? Mercy Jeruto, Betty, what is the challenge? Shida iko wapi? Shida iko wapi? The figure is balancing. It means our ledgers were okay. Shida iko wapi watu wangu? Iko sawa. Don't take long to answer. So I think we can have a small break and then we come back, we continue. So a small break and then we come back. Is that okay? Okay. With your team, if you're there, we just respond to. Are we together? I've said that topic 3 is an handout form. Regulation, those regulation, accounting concepts, accounting principles, those are in an handout altogether. So I start on my topic 4, that is accounting for assets and liability. Accounting for assets and liability. Together, team, accounting for assets and liability. Are we there? Accounting for assets and liability. Tuko pamoja. We respond if you're there. So start with, just say assets. We say PPE, property, plant, and equipment. That is an international standard, IAS 16. Accounting for assets and liability. Tuko sawa. Betty and Mercy, are we there? I'm saying topic 3, that is regulation. Those accounting principles, regulation, AIS, IFRS, just a brief analysis, that one is in notes. So I start with accounting for assets and liability. Are we there? Topic 4. Tuko sawa. If you're there, we just respond with a yes. Kindly respond so that we can proceed. Betty, are we there? Geruto, are we there? Mercy, are we there? I've said accounting for assets and liability. And we start with assets, that is property, plant, and equipment. That is IAS 16. Are we there? I wanted to respond if you're there. Betty, I don't know what's the challenge today. Betty, just say yes. When you say yes, then I proceed. Accounting for assets and liability. And asset, that is property, plant, and equipment, that is IAS 16. Tuko pamoja. So I can proceed to mean that we are there. So just to say that the objective of this standard, to know that the objective of this standard, is to prescribe the accounting treatment, for the objective of this standard is to prescribe accounting treatment for property, for PPE inamaanisha, that is PPE inamaanisha is to prescribe accounting treatment for PPE so that users of financial statement, so that the users of financial statement can discern users of financial statements can discern, so that users of the financial statements can discern, saying that so that the users of financial statement can discern information, can discern information about, they can discern information about the entity, entities, investment in property, investment in property, plant and equipment, investment in PPE. Took us all of us, but the objective for that is that the objective of the standard is to prescribe the accounting treatment for PPE, so that users of financial statement can discern information about entities' investment in PPE. So we can note and say this: PPE and changes in such investment, and the changes in such investment, and changes in such investment. That is the objective of that. That is the objective of that. I want to pick on, start on the first thing, that is depreciation. I start on the first thing, that is depreciation. What is depreciation? When I say depreciation, Betty, are we there? If you're there, we just respond with a yes. Marcy, are we there?
Yes, I'm there.
Yes, so that is accounting treatment for assets and liability. Marcy, I hope Marcy is there. I've said topic 3, I've already prepared the handout on accounting regulations, accounting concepts, accounting qualities of a good accounting. Those ones you will have them. Sorry, I was not able to send them, but as I get back home tomorrow, I will send those notes, topic 3. I want us to finish on this accounting treatments for asset and liability, then we get to sole trader. Now we get to calculations, the major areas of the calculations. So we start on depreciation. What is depreciation? And before that depreciation, I'll say that when we talk about this IAS 16, the objective of that standard is basically to prescribe accounting treatment for PPE, so that the user of financial statement can discern information about the entity's investment in PPE and changes in such investment. So we start on depreciation. So what is depreciation?
Depreciation is loss of value.
Is the loss of value, basically loss of value. Loss of value of. So meaning is the loss of value of fixed asset, loss of value of PPE. That is what we call depreciation. So depreciation is the loss of value of PPE. So we can just say in all stroke, we say refers to denomination, denomination in the value of assets, denomination in the value of assets due to wear and tear. So the loss of value of fixed asset due to wear and tear. Today, for example, if you're to buy a car, altogether, after a couple of days, you find the car losing value and losing value altogether. After buying the car, you'll find it losing value and losing value together. So that is what you call depreciation together. Sawa. Losing value due to wear and tear. Are we together? Or passage of time. Passage of time. Passage of time. So when time goes, you find an asset will definitely lose value. So risk causes of depreciation. So we need to understand that true profit of the business cannot be ascertained unless depreciation has been allowed. Unless depreciation has been allowed, that we cannot ascertain the true value or the profits of the business unless depreciation has been allowed altogether. So we can go to causes of depreciation. We can discuss causes of depreciation. Very fast, causes of depreciation. One, we talked about wear and tear. As one of the first cause, wear and tear. When an asset, run, wear and tear, due to actual use, that is one actual use. When you use an asset, it's always wear and tear, that is the first one. What do you think, Betty, is another reason cause of depreciation?
Just passage of time.
Passage of time, definitely. Or effluence of time, passage of time. Another cause of depreciation, we call it obsolescence. Obsolescence, and obsolescence means obsolescence, a new invention, or permanent change in demand, or permanent change in demand, So then we can also have other users come accidents, Accidents is another cause. So we can also talk about fall in market prices. So these are some of the causes of depreciation. You can have a question on depreciation, accounting for this depreciation, and they told maybe the first part of it, identify 5 causes of depreciation. So I'm saying that wear and tear is one of the costs. This passage of time, obsolescence, like for example, a new invention or permanent change in demand. Then we have accidents and the fall in market price together. Then also a very good area, objectives of providing. We start with the objectives of providing depreciation. What do we need to provide for depreciation? We call it objectives of providing for depreciation. Objectives. Why do we need to provide for depreciation? We call it objectives. Why do you think we need to provide for depreciation? Betty, objectives of providing for depreciation. Why do you think we need to provide for depreciation?
So if depreciation is useful to get the true value or profit of the business, then
great.
it will help us to get the true value of the assets we own.
Definitely, that's a good one. So objectives of providing for depreciation. Objectives of providing for depreciation. Objective for providing for depreciation. Objectives for providing for depreciation. Objectives for providing for depreciation. One of it we say to ascertain the value of assets and the financial position. One is to ascertain the value of assets, to ascertain the value of assets and financial position. And that is true, depreciation will enable you to get the net book value, meaning the current value of the asset. But at the same time, you're also able to get the financial position, which is the balance sheet altogether. Two is to make provision. We call it to make provision. We say to make provision for replacement of worn out assets. Provision for the worn out assets. We have number 3, we say to correct the correct amount of profit or loss. To calculate, we say to calculate the correct amount, of profits or loss. Correct amount of profits or loss. To get the correct amount of profits or loss, we can also say that to compute the cost of production. To compute the cost of production. Another one would be to compute the cost of production. Then we can also say that to comply with legal provisions, to comply with legal provisions, to basically comply with legal provisions, to comply with legal provision. So we know that one of the section 205 of the Company Act provide that depreciation of fixed assets must be charged and necessary provisions must be done together. So to comply with legal provision, we can also talk about number six to avail of tax benefit, tax benefit. What do you mean to avail of tax benefit? To avail of tax benefit, that is basically income statement of accounting will show how profit will show more profit if the position is not charged. This case, the business needs to pay more income tax altogether. So to avail for tax benefit altogether. So if at all the position is not charged, it will show that you are going to pay more taxes altogether. So when you calculate it, it avails what to call a tax benefit. It avails what to call a tax benefit. Together, Betty and Mercy.
Yes, we are together.
So from now, we are going to proceed to methods of calculating depreciation. Methods of calculating depreciation. Methods of calculating depreciation. That will be the next thing altogether. Before even we take it in the next class, what are some of the methods of calculating depreciation that you know, Betty and Marcy?
I know the straight line method.
Straight line method, another one? There's so many. Another one apart from that?
You could also tag a fixed percentage too.
Straight line method is a good one. Now we have reducing balance. We have what you call reducing balance. We have revaluation method. We have the sum of digit method. So a number, we are going to discuss a few of them briefly. We're also going to talk about disposal and exact together. So far, I can say we are moving on well. This is the core. Once we finish on this part on accounting for asset and liability, we talk about how we treat prepayments, how we treat accruals, bad and doubtful debt. Once we finish on that and we do disposals, PPE schedule, that will be the core. Then we start on the financial statement. On the financial statement, we just need format, and then we begin to do questions altogether. So topic 3 nimesema ya regulation. Natuma hiyo pole. I've not been able to send that topic 3 on regulations. There's accounting concepts, qualities of good accounting systems. Hizo ziko on topic 3. Please, if I forget, Mercy or Betty, remind me tomorrow on Sunday. Just remind me on Sunday by around 12, so that I send that handout for topic 3. Is that okay?
Sawa.
Asante. Tafadhali mkuu mkiattend class, please don't miss class. When you miss class, we mess it up. Asante. Once we get to those sole trader, most of the questions are together, particularly for CPA, but now for Mercy, those accounting concepts, regulation, because it's a multiple. Like if you look at the previous questions they were asking on regulations, please read those regulations. As I give you that handout on Sunday, I will talk about it briefly. That handout briefly. Code of conduct, professional ethics, I will talk about it briefly. That is a very important altogether. That is also a very important handout. So Mungu awabariki, and we'll meet in the next class, which is Sunday. God bless all of us. Let's meet on Sunday.
Okay, thank you.
Asante.
Good night, everyone.
Good night, Betty.